Hi, welcome to Money9, India's first multilingual personal finance news service from TV9 Network. I'm Karthik Malhotra, and joining me today on the Money Masterclass is none other than Feroz Aziz. Feroz, thank you so much for joining us again on Money9. Welcome back. Last time we had done the absolute chapter 1 of mutual funds. Let's progress to chapter 2 today. For starters, very simple. How do you define equity mutual funds versus debt mutual funds, and who should invest for which one?
See, when you collect the money as a fund manager, if an asset management company collects money and invests in stocks, it's called equity mutual fund. If they invest in bonds or FD-like instruments, that's called a debt fund. So equity funds and debt funds invest in two different kinds of instruments. Equity is nothing but being partners to corporates. Debt is nothing but lending to corporates. So the risks are different. The risks, of course, in equity are higher than in debt because you're lending in debt. You're becoming partners in equity, point one. Point two, who should invest? Everybody should invest in both these categories. The nitty-gritty is in the proportions. The customization is in the proportions depending on the stage of life, the risk appetite, and the goals which an individual sets for himself or herself. So it's both the categories are for everybody in different proportions at different points in time.
Right. Is it safe to assume, Feroz, that equity investments like equity mutual funds are high risk, hence high return, whereas debt funds are lower risk and potentially lower return too?
Yes, because there's no gain if you don't take the risk or the pain. So
Right.
equities have a potential of delivering a significantly better return than debt over the long periods of time. So you're absolutely right. Debt is low risk, low return. In the contemporary situation, the expectation from a debt fund, from a 3-year investing perspective, should be between 5 and 7% a year. On the equity side, looking at where we stand in the economy and this post-pandemic world, the expectation would be double digit on a 3-year investing period. So that's about 12-13% kind of expectation wouldn't be unfair for an investor standpoint.
Right. So there's also more confusion around something in between. So some people call these funds flexi funds or multi-cap funds. What are these? Are these equity? Are these debt? Are these somewhere in between?
See, the ones which are in the between are called the hybrid funds.
Okay.
In the hybrid fund category, you have different funds subcategories depending on the proportion between equity and debt. If a person does not want to make this decision on a regular basis of how much in equity, how much in debt, then you go in for a hybrid fund.
Got it. And while we are discussing one versus another, are mutual funds and exchange traded funds the same? Are MFs and ETFs the same thing, or is there some difference between the two?
ETF is nothing but a mutual fund. It is a subcategory of a mutual fund which gets traded on the exchange. A normal mutual fund has subscription in physical form or in digital form with the asset management company. If I want to invest 1,000 rupees in a fund, in an open-ended equity mutual fund, not an ETF, I will give an application to the asset management company and I'll get the units. In an exchange traded fund, I have to take this money to a broker. The broker punches an order just like a stock on the exchange and gets the desired units in my demat account. So exchange traded, as the name suggests, trades on the exchange. The rest of the mutual funds you buy and sell with the asset management company, not on the exchange. I do.
Right. Now, sticking to the theme of mutual funds, and that's the masterclass that you're addressing for our viewers here. There is also, anytime you go and buy a mutual fund or do your research about buying a mutual fund, you get multiple options within each fund. So there's growth, there is regular, there is dividend, there is direct. How does a consumer or a user or an investor decide which mutual fund or which format of mutual fund is right for him?
See, let me break down your question into two different classifications. One is growth and dividend. The other is regular and direct. These are the four which you mentioned. First, let's focus on growth and dividend. Growth is nothing but whatever you earn doesn't get paid to you ever. It just keeps compounding inside the fund itself. Okay, if the NAV from 10 rupees went to 12 rupees, the fund manager does not give away this 2 rupees to you at a point in time or ever. And it keeps compounding and multiplying. Dividend is the fund manager is looking for opportunities to encash the profits and pay it
Okay.
to you. So if you are a person who wants regular income or at least a sporadic inflow in your bank account, dividend is the alternative. If you are a young person want to compound the money, then growth is the best one. So that's one classification, Karthik. The other classification is based on the cost of it, regular and direct. Direct, as the name suggests, you don't have any advisor. You take your money, straight go to the asset management company and cut the middleman. That's direct. Regular is take an advice from an advisor who can help you make money from his capability of research and give you that extra return, for which you pay that 1% extra in the form of fees between these two alternatives. So direct is a cheaper option. Regular is an expensive option. Expensive because the intermediary gets paid in the regular option for the advice he ends up giving the investor.
Right. But can I switch between the two? If I have invested in a regular fund and the fund is doing well, at some point, is it fair and is it even practical to switch from a regular to a direct?
Mutual fund is one of the most flexible platforms anybody could envisage. So yes, you can switch between regular and direct and regular, vice versa. And growth and dividend are also something which you can switch. When you switch between growth and dividend, you don't even have an exit load when you make movements. Between direct and regular, when you switch, you have an exit load.
Right. Okay, Feroz, at this point, let's do what you enjoyed doing with us last time, our Money Masterclass rapid fire round with Feroz Aziz. If you're ready, I'll start firing away the questions.
Please go ahead, Karthik.
Okay, question 1. SIP is always better than lump sum when investing in mutual funds. True or false?
Not always. They're meant for different things at different points in time.
Okay. So that's somewhere in between. It's neither a true or nor a false.
Okay.
All right. The best way to invest is through a financial advisor only. True or false?
Yes, true.
All right. Mutual funds cannot be liquidated easily. True or false?
False.
Stock markets have nothing to do with mutual fund returns. True or false?
False.
One should only invest when markets are down. True or false?
False. You should invest at all points in time.
Right. Physical assets are safer than financial assets. True or false?
False. Because, for example, if you...
Yeah.
I'd like to add, because our love for physical assets as Indians is very high. If you buy a property, you might be taking more risk than sometimes buying equity as well.
Is that true in the case of gold also? Because you can at least see it physically and hold it in a vault and liquidate it to a neighborhood jeweler whenever you want?
It's true that it can be more riskier than financial assets because it is more riskier than debt for sure.
Okay. Right. So continuing with our rapid fire, next question. Starting early with small amounts is always better than starting late with a lump sum. True or false?
Absolutely true.
Mutual fund returns are tax-free. True or false?
False.
Traditional investments like PPF and fixed deposits are safer than mutual funds. True or false?
True, to a large extent.
Feroz Aziz, thank you so much for taking this Money Masterclass for all our viewers. Pleasure having you on Money9 as always. We look forward to welcoming you once again very soon. That's a wrap on the Money Masterclass with Feroz Aziz. This is Karthik Malhotra signing off. Goodbye.